Anyone with a ruler and a pencil can draw a line on a stock chart. The landscape of modern technical analysis is crowded with an endless array of trend lines, channels, and projected price targets. Yet, for all this line drawing, the fundamental problem remains. Most traders are consistently surprised by the market's action. They watch in frustration as their carefully drawn support lines are violated with ease, and their resistance levels are overrun by an unexpected surge of momentum. The market, it seems, does not respect their lines. The genius of William Delbert Gann was not in the simple act of drawing lines, but in his scientific method of identifying the specific, mathematically derived price levels that truly matter, the levels that are embedded in the market's very architecture. But his method went a crucial step further. He did not just identify these levels. He developed a complete system for determining their strength. He sought to answer the single most important question a trader can ask. When a stock approaches a critical price level, what determines if it will hold, causing a reversal, or break, causing an acceleration of the trend? This is the key that unlocks the practical application of his entire methodology. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The foundation of the entire Gann framework of support and resistance begins with a simple, observable principle. The market has a memory. Past price levels where significant battles between buyers and sellers took place are not forgotten. They become reference points for future market action. The most fundamental of these levels are old highs and old lows. William Delbert Gann taught this as a primary rule. An old top, once it has been decisively surpassed, becomes a new level of support, or a floor. Conversely, an old bottom, once it has been clearly broken, becomes a new level of resistance, or a ceiling. To understand why this principle works, one must understand the human psychology that drives it. Consider a stock that rallies to a high of $100 and then enters a prolonged decline. Three groups of market participants have now mentally anchored themselves to that $100 price point. The first group consists of the unfortunate buyers who bought at or near the top. As the stock declines, they are trapped in a losing position. Their primary emotional driver becomes the desire to get out even. They will wait patiently, sometimes for months or years, and if the stock ever rallies back to their entry price of $100, they will sell, creating a wave of supply. The second group consists of the short sellers who correctly sold at the $100 high. As the price rallies back toward that level, they will see it as an opportunity to defend their profitable position by selling more, adding to the supply. The third group consists of traders who missed the opportunity to sell at $100 and now see its return as a second chance. They too will sell. The confluence of these three sources of selling pressure is what makes an old high a natural and powerful zone of resistance. Now consider what happens when, after a period of consolidation, the buying power is so immense that it is able to absorb all of this selling pressure and push the price decisively above the old high of $100. The entire market dynamic is now inverted. That old ceiling has become a new floor. Why? Again, the reason is found in human psychology. The traders who sold at $100 expecting the resistance to hold now realize they have made a mistake. If the stock pulls back to $100, they will often buy to cover their short positions, creating demand. The traders who hesitated, waiting for the breakout to be confirmed, now see the pullback to the old high as their perfect low-risk opportunity to get in on the new uptrend, and they will buy, creating more demand. The original buyers who sold at break-even now see the stock continuing to advance without them and will often buy back in at the same price, adding to the demand. This is why a pullback to an old broken resistance level is one of the most reliable buying opportunities. The same logic works in reverse for old bottoms, which once broken, become powerful resistance levels on any subsequent rally. This principle of old highs and lows is the first layer in building a map of the market's architecture. While the foundational levels of old tops and bottoms provide a basic structure, the true predictive power of the Gann methodology is found in its next, more advanced layer, the mathematical price levels derived from percentages. William Delbert Gann did not believe that price movements were random. He believed they were governed by precise mathematical laws and that every major high and low was mathematically related to past and future turning points. His primary tool for discovering these hidden relationships was the calculation of percentage levels. He wrote, "One of the greatest discoveries I ever made was how to figure the percentage of high and low prices on the averages in individual stocks. He established a clear hierarchy of these percentages, which form the core of his price forecasting system. The most important of all these divisions is the 50% level. William Delbert Gann stated, 'The most important resistance level is 50% of any high or low price.' This halfway point represents the market's center of gravity, a point of perfect equilibrium between the bullish and bearish forces. He applied this rule in several ways. First, a 50% decline from any major or all-time high price is a critical potential support level. For example, after the great 1929 bull market peak at 386.10, he calculated that the 50% level was 193.05. The first panic wave of the crash ended on November 13, 1929, at a low of 195.35. Holding just 2 points above this immensely powerful support level before staging a massive secondary rally of over 100 points. Second, he calculated the 50% point of the range between any significant high and any significant low. A rally that retraces 50% of the previous decline will meet major resistance. A decline that gives back 50% of the previous advance will find major support. This 50% rule is the master key to his price analysis. The next most important levels are the quarter points, 25% and 75%. A decline of 25% from a major top is the first significant warning that the trend is in trouble and often serves as the first major support level in a new bear market. For example, after the 1946 high of 213.36, a 25% decline calculates to a level of 160.02. The market made its final low for that bear market on October 30th, 1946, at 160.49, holding almost perfectly at this 25% level before a new bull phase began. The 75% level represents an extremely severe decline and often marks the final zone of liquidation in a great panic, as seen in the 1932 bottom, which occurred after wiping out nearly 90% of the 1929 high. Other critical divisions that William Delbert Gann used were the thirds, 33 1/3% and 66 2/3%, and the eighths, such as 12.5% and 37.5%. To create a complete map of a stock's potential support and resistance zones, a Gann analyst must perform these calculations from every major historical top and bottom. He must calculate the percentages of the all-time high price, the percentages of the all-time low price, and the percentage retracements of every major swing between them. This is not guesswork. It is a methodical, mathematical process of identifying the natural, harmonic, and divisional points of a market's price structure. By doing this work in advance, the trader is prepared. He knows, long before the market gets there, where the major battles are likely to be fought. He is no longer surprised by a reversal. He is anticipating it at a pre-calculated zone. We have now defined the levels. The next step is to understand the forces that determine whether they will hold or break. To have a map of the market's architecture, to know in advance where the critical battlegrounds of support and resistance lie, is to possess a powerful strategic advantage. But a map alone does not win the war. The most critical skill a trader must develop is the ability to read the battle as it unfolds, to determine in real time whether the forces of supply or demand are winning at these pre-calculated levels. William Delbert Gann was a master of this art. He taught that the arrival of a stock at a major support or resistance level is not, in itself, a signal to act. It is a signal to watch. It is an alert that a potential turning point is at hand, but it demands confirmation from the market's own action. To buy a stock simply because it has fallen to a 50% support level is to act on incomplete evidence. The professional waits for the market to prove that the level is going to hold. This section is dedicated to the specific observable signals of confirmation that William Delbert Gann waited for, the signs that a Gann level was in fact going to become a floor or a ceiling for the market. The first and most powerful confirmation of a level's strength is the market's repeated failure to violate it. When a stock declines to a major support level and then rallies away from it, it has demonstrated that demand was present at that price. If, after this rally, it declines a second time to the exact same support level and again fails to break through, it has created a double bottom. This is a far stronger signal than a single touch. It is the market's way of saying that not only was demand present on the first test, but it remained present and was strong enough to absorb a second wave of selling. William Delbert Gann placed immense importance on these formations. He wrote, "Buy at double and triple bottoms. This is often the safest place to buy or sell because the market moves away from a triple top or a triple bottom much faster. A triple bottom, where the market tests the same support level 3 times and fails to break it, is an even more powerful signal of accumulation and underlying strength. The psychology is clear. The sellers have made 3 distinct attempts to push the price lower and have failed each time. Their power is exhausted, and the buyers are in control. The same principle applies in reverse to double and triple tops, which are formidable signs of distribution and impending weakness. When you see a major Gann level, be it an old low or a 50% retracement, transform into a double or triple bottom, you have received your first major piece of evidence that the level is going to hold. The second critical confirmation signal is read from the volume of sales. Volume, as William Delbert Gann taught, is the force, the effort behind every price move. The character of the volume as a stock approaches a key support or resistance level provides an invaluable clue as to whether the trend is strong enough to break it. If a stock is in a powerful downtrend and is approaching a major support level, a professional trader watches the volume with intense focus. If the volume begins to significantly decrease as the stock drifts down to the support level, it is a sign of trend exhaustion. This drying up of volume indicates that the selling pressure is dissipating. The effort required to push the price lower is fading. This is a powerful indication that the downtrend is running out of fuel and is unlikely to have the force necessary to break through a major support zone. This lack of volume is a subtle but critical signal that the sellers are losing control and that the level is likely to hold. Conversely, imagine a stock in the final stages of a bear market. It experiences a high-volume selling climax, a panic-driven washout where price makes a final dramatic low. This is followed by an automatic rally, and then a secondary decline back toward the panic low. If this secondary test occurs on drastically lower volume than the climax, it is a powerful confirmation that the selling pressure has been fully exhausted. The lack of volume proves that the panic is over and that there is very little stock left to be sold at these low prices. This test on low volume at a major Gann level is one of the most reliable buy signals in his entire methodology. It provides strong evidence that the support level will hold and that a new uptrend is beginning. The final and most immediate confirmation that a Gann level will hold comes from the price action itself, as recorded on his swing charts. While the formation of a double bottom and the character of the volume can take weeks to develop, the swing charts provide the precise mechanical trigger for when to act. After a stock has declined to a major support level, the Gann trader is on high alert, watching his 3-day swing chart. The trend on this chart is still down. He waits. The stock rallies away from the support for a day or two, but this is not enough. He must wait for the chart to confirm a reversal. Finally, the stock puts in 3 consecutive days of higher highs and higher lows, and in doing so, it crosses the top of the last minor swing on the 3-day chart. This is the first mechanical signal that the immediate downward pressure has ceased, and that the trend, at least on a minor basis, has turned up. For the aggressive trader, this may be a sufficient signal to enter a position, placing a stop-loss order just below the major support level that has just proven to hold. For a more conservative confirmation, particularly for a major trend change, the trader would then turn to his 9-point swing chart. A reversal on this chart, which filters out all moves of less than 9 full points, is a much more significant event. If after a successful test of a major support level, the stock rallies with enough force to reverse the trend on the 9-point swing chart, it is a powerful confirmation that not just a minor rally, but a new sustainable intermediate uptrend is likely underway. The confluence of these signals, a stock holding at a pre-calculated Gann percentage level, forming a double bottom on diminishing volume, and then confirming the turn on the 3-day and 9-point swing charts, is the definite indication that William Delbert Gann taught his students to wait for. It is the moment when all the evidence aligns, providing a high probability, low risk opportunity to enter the market. To truly master the art of reading the market's action at these critical junctures, to interpret the subtle interplay of price and volume that confirms whether a level will hold or break, one must go to the source. The rules and principles we are discussing are but an introduction to the deep and practical science laid out by William Delbert Gann in his foundational masterpiece, Truth of the Stock Tape. This book is not a theoretical treatise. It is a hands-on manual that teaches you how to read the tape as he did, to understand the story it tells about the constant battle between buyers and sellers, between the informed insiders and the hopeful public. It is a complete course in judging the position of stocks, identifying accumulation and distribution, and determining the main trend. In preparing this analysis for you, we have gone to great lengths to uncover the original materials. We were able to locate in archives over a century old the very charts that William Delbert Gann himself included in the first edition of Truth of the Stock Tape. We must be honest about their condition. Not all have survived the passage of time in perfect form. Some are remarkably clear, while others are more difficult to read. We ask that you do not judge them too harshly for their appearance. What could be done to preserve them has been done. Their value is not in their visual perfection, but in their immense historical and educational worth. They are a direct window into the mind of a master, showing you exactly what he was looking at when he formulated his timeless rules. The true value lies in the material itself. For any serious student who wishes to move beyond simply drawing lines and truly learn to read the market's intent, this book is indispensable. We have made this invaluable resource available through the link in the description below. Just as a skilled general must know when to defend a fortified position, he must also know when the enemy's defenses are about to crumble. The successful trader likewise must master not only the art of identifying support and resistance, but also the science of recognizing when a breakout is imminent. To only ever act at levels that hold is to capture only 1/2 of the market's opportunities. The greatest and fastest profits are often made not at the points of reversal, but during the powerful, momentum-driven moves that occur after a key level has been decisively broken. William Delbert Gann's methodology provides a clear set of signals for this exact purpose. These are the signs of strength and momentum, the clues that a stock is not preparing to reverse, but is instead gathering the force necessary to push through a ceiling or break through a floor into new territory. This is the mirror image of our previous analysis, the study of what happens when levels break. The first and most critical signal of a valid breakout is a significant and undeniable increase in the volume of sales. William Delbert Gann, like all master tape readers, understood the fundamental market principle of effort versus result. The volume is the effort. The price movement is the result. For a major result to be achieved, such as breaking through a long-standing resistance level where a large supply of stock is known to exist, a tremendous amount of effort is required. This effort manifests as a surge in volume. This high volume is the definitive proof that the buying power is not only present, but is aggressive and powerful enough to absorb every last share offered by the sellers at that resistance level. It is the sound of the battle being decisively won by the forces of demand. A breakout that occurs on low or merely average volume is immediately suspect. it is a result without a corresponding effort. This often indicates a lack of genuine professional demand, and may be a manipulative move known as an upthrust or a bull trap, designed to lure in unsuspecting buyers just before the price fails and reverses. William Delbert Gann taught that such moves should be distrusted. The patient professional waits for the confirmation of force. When he sees a stock push through a major old high and he sees the volume on the tape swell to a level far greater than the preceding weeks, he has his confirmation. This is not a guess. It is evidence that the character of the market has changed. The supply that once capped the price has been conquered, and the path of least resistance is now higher. This harmony between the breakout in price and the surge in volume is the first and most essential signal that a level is not just being tested but is being broken for good. The second signal that a level is likely to break is often found in the price action just before the breakout occurs. This is the period of preparation or consolidation before the level. Imagine a stock rallies up to a major resistance level at $100. An amateur trader might see the price stall and immediately conclude that the level is holding and sell short. The professional, however, watches the character of the reaction. If the stock, instead of having a sharp, deep correction, begins to trade in a very narrow, quiet range just beneath the resistance, for example, between $97 and $99, this is a sign of immense underlying strength. This tight sideways consolidation is a sign that the stock is not being rejected by the supply at $100. Instead, the buyers are so persistent that they are absorbing all the selling pressure in that area without allowing the price to decline significantly. This coiling action, this building of a narrow base at a high level, is a sign that force is being gathered. It is akin to an army massing its troops just outside the walls of a fortress before the final assault. The sellers at $100 are feeding their stock into the market. But instead of driving the price down, it is being quietly absorbed by an even more powerful force of demand. The longer the stock can hold in this narrow range just beneath the high, the more of the overhead supply is being taken out of the market and passed into strong hands. This is a subtle but incredibly powerful signal. It shows that the sellers are becoming exhausted, and it indicates that the next move is far more likely to be a breakout to the upside than a breakdown. The patient trader, seeing this formation, does not sell at the resistance. He prepares to buy the breakout, knowing that the preparatory work has already been done. The third and most advanced factor in determining if a level will break is the time factor. William Delbert Gann taught that time governs all. The duration of the market's preparation and the position of the market within its major time cycles provides the final layer of evidence. First, the longer a stock consolidates and prepares beneath a resistance level or above a support level, the more significant and powerful the eventual breakout will be. A stock that builds a base for 10 months will have a much larger and more sustained move than a stock that prepares for only 10 days. The extended period of time allows for a greater amount of stock to be absorbed by insiders and removes more of the floating supply from the market, clearing the path for a more dramatic move when it finally comes. Furthermore, a trader must always consider the position of the market within its main long-term time cycle. If a stock is only 6 months into a major bull market that is expected to last for 2 years or more, any minor, old resistance levels in its path are far more likely to be broken. The overarching primary force of the main bull trend will act like a powerful tide, easily overwhelming the smaller waves of selling that appear at minor resistance points. Conversely, if a market is at the end of a major time cycle, approaching a key anniversary date or the culmination of a multi-year advance, even a breakout to a new high is highly suspect and may be the final exhaustive move before a major reversal. By integrating time analysis, the trader adds a crucial dimension to his judgment. Time helps him to gauge the probability of a breakout. A breakout that occurs early in a major time cycle and after a long period of consolidation is a high probability A-grade opportunity. A breakout that occurs at the end of a time cycle after a short consolidation is a low probability, dangerous trade. In conclusion, The price levels identified by William Delbert Gann are not magic lines that cause markets to turn. They are a roadmap to the market's underlying architecture, highlighting the specific price zones where the great battles between supply and demand are most likely to occur. The ultimate secret to knowing what holds and what breaks is not found in the levels themselves, but in the integration of these levels with the confirming evidence from the market's other dimensions. The professional trader, using the methods of William Delbert Gann, does not act on a single piece of evidence. He builds a case. He waits for a confluence of factors, the formation of a double bottom, or a tight consolidation on his charts, the message of force and effort from the volume of sales, and the critical timing signal from his time cycles. It is this systematic, multi-layered, evidence-based approach that separates professional analysis from amateur line drawing. It is the hard work of preparation, study, and patient observation that removes guesswork and emotion from trading. And it is the key to transforming speculation from a gamble into a consistent, logical, and profitable profession.